Right, big question. What can a nickel teach us about trading? Now I can imagine some of you sitting there pondering, thinking, a nickel, that rings a bell. What is it, some sort of technical trading term? Is it some sort of legendary trader's surname? No, I am literally talking about a little US 5-cent coin, a nickel. What can a nickel teach us about trading? Some of you may be familiar with the name Kyle Bass. For those of you that don't know, Kyle Bass is a very successful and famous hedge fund manager. He basically predicted the subprime crisis happening in 2007, 2008. He foresaw it coming, I think 2 years before, bet against the industry and became a multi-millionaire. He later became quite famous, all thanks to Michael Lewis's now extremely famous book, The Big Short, which was later made into a film. However, it wasn't until the follow-up book, also by Michael Lewis, surprise, surprise, called Boomerang, that I heard about Kyle Bass's story with the nickels. So the story goes that Kyle Bass took delivery of 1 million nickels. That's 20 million 5-cent coins. Now, why do you think he would do that? Why do you think he'd want to take delivery of 20 million 5-cent coins? That's a hell of a lot of coins. Now I'm sure some of you know the story already, so don't ruin it for anyone else. But if you don't know it, why not pause the video, go to the comment section without looking at anyone else's answers and have a guess as to what you think is the reason for taking delivery of so many little coins. Well, the reason is that Kyle Bass found that these little 5-cent nickel coins, 5-cent coins, were actually worth 6.8 cents in terms of their scrap metal value. So he could get them for 5 cents each, and he got 20 million of them, and immediately they were going to be worth 6.8 cents each in terms of the scrap metal. Now obviously there's all kinds of laws about not being able to melt down coins and that kind of thing, but still, that's 5 cents to make 6.8 cents instantly. So what can a nickel teach us about trading? Well, it's all about asymmetric risk returns. Okay, so very basically, asymmetric risk returns are those situations where the potential upside if you're right far exceeds the potential downside if you're wrong. This is why a lot of traders go for 3-to-1 trades, 2-to-1 trades, 5-to-1 trades. It means that you don't need to be right every single time to make profit overall. You don't even need to be right 50% of the time if you're opening, say, a 2-to-1 trade, for example. Now this is very basic and everyone understands it. We went into a lot of detail about it in a video a few months ago about probability. And this is one of the most important lessons that we've had. It's going to be linked in the description box down below. So I don't want to go into too much detail about that again, but we spoke about basically the difference between just looking at success rate probability and the outcome if you're right or wrong. Now, a lot of people are short-term focused and they're just focusing on the success rate. They say, I'm going to go for this trade because there's an 80% chance of me being right. But this is not the right way to look at things. You also need to look at what the outcome is either way. So this video is sort of a reminder because I've seen a lot of things recently where people have been getting it wrong. And with the big swings in the market over the past week or so, people have been caught out because they haven't been following this very simple principle. If we go back to Kyle Bass's example, this is a multi-millionaire. He doesn't really care that much with a £1 million trade, like buying those coins, not really a trade. But it's just that mindset of looking for asymmetric situations. It's not enough just to go for a 3-to-1 trade, but you need to think to yourself, is this actually an asymmetric opportunity? And the way I like to think about it, and I'm not condoning gambling, and I'm not saying we need to learn from gamblers, but the way a professional gambler approaches their gambling is very different to someone that has a flutter every now and then. So a professional gambler will sort of play with the odds. They might think that, for example, Arsenal are going to win the match, and yes, sometimes Arsenal are the favourites to win a match, we win occasionally, but they might think that Arsenal are going to win, but when they look at the odds, they see that that's priced in already. However, the odds of them losing is maybe underpriced, and therefore, over the long term, that's the bet to take. And this is the same way we need to think about our trading. Yes, it might be that we think Euro-US dollar is going to go up, but if the potential profit there is only 100 pips, and the downside's 1,000 if it's going to crash, and there's a 20% chance of it crashing, then that's the trade we should be going for. But what I've seen recently is people getting caught into seeing a certain market type and seeing that they can get away with things too much. There was a post on the forum this week where someone burnt out their account, and it's because they broke certain rules, because I think they got caught into this cycle of the markets being in a range, and you know that if you open a trade and it goes out of like in a loss for a while, eventually it will come back because it's just swinging in this sort of range for a while. But eventually it breaks out of that range. And the downside when that happens and you've been clinging on to that trade is that you get a burnt out account. Look at the people that have been shorting vol for all this time, going short on the VIX. It was pretty much a cash machine for a while. You could print money just by shorting the VIX. It was going down and down and down until one day this week it spikes up and people got wiped out. Certain ETFs were down like 85% or something. These people that have made these small profits over time, that maybe the 999 trades they made $1, and that 1 out of 1,000 trade they lost 10,000. It doesn't make sense to be doing that. You also saw it with Bitcoin, and this reminds me of something that Nassim Taleb sort of explains very well in his book Fooled by Randomness. He says that bad traders can also make money for a good amount of time. Like when you go to banks and stuff, the people that are really the high performing traders may be the ones that eventually burn out and lose their entire career. Because for a certain amount of time, the way they're trading suits that market type. It's not that they're a good trader that lost their touch, it's that there was a certain slant in their trading that was working with those certain market conditions. But when the market conditions changed, they realized that they were so high risk and they just didn't factor it in at that point in time. So we need to factor in the long term. I think the problem is people being so short-term focused. They care more about, is this trade going to be right or wrong? Is it an 80% chance of making me money? But they're forgetting about that long-term risk reward, that long-term profitability. And we need to consider this. And when I said about Bitcoin, the reason it reminds me of that is because some people got extremely rich by being the type of people that constantly buy the dip. So every time Bitcoin sort of retraced a little bit, they were buying more and holding on. And of course, that seemed very profitable for a certain amount of time and people made a lot of money. But a lot of those people got carried away and kept buying the dip, and now look what happened. Bitcoin had a big correction and these people are now suffering. They've lost a lot of the money that they made, probably more. They've probably lost a lot of their capital, some of these people. Some people were smart enough to bank their money and get out, but you never know when this cycle is going to end of being able to do a certain strategy. So we need to think long term. We need to think asymmetric returns in all situations, and not just think a 3-to-1 trade is enough, but also think about what the outcome is in all situations. You need to be thinking long term with every single trade you do. Don't just think like this one's got an 80% chance of succeeding and it's only one trade, I'll just go for it. Because it might be that that first trade you open is the 1 in 1,000 that fails and fails miserably. So I guess you can call this a public service announcement. It's a reminder to be sensible, stop getting carried away, stop getting too complacent and cocky, and think about the probabilities and the outcomes and everything you do. Now, I would really recommend that you check out the link to the probability video that we did in the description box. This week, I'm going to be talking in a lot more detail about the VIX short that people were doing and what the outcome of that was, as well as Bitcoin and assessing, the rise and fall and what could have been done about that and what's going to happen next. So make sure you subscribe to the channel so you don't miss out on any of it. If you like this video, then please do hit the thumbs up. If you've got any comments and questions, leave them below. We'll go into a lot more detail about all of these things soon, and I hope that you'll join us for it. Take care, thanks for watching, and I'll see you soon.